But first, let's bring in our market panel. Tony Roth of Wilmington Trust and Kevin Mahn of Hennion and Walsh Asset Management. We have you both on set here with me, so welcome. And Kevin, I'll start with you. S&P 500, 41st all-time high for the S&P so far this year. Where do we go from here?
How much higher can it go, Morgan? We also saw that consumer confidence dip to a 3-year low earlier today as well. And I think consumers are starting to get more and more concerned with the pace of this economic slowdown. They see that the Federal Reserve's first interest rate cut was 50 basis points, not 25 basis points. We also know that they plan on cutting by another 50 basis points this year and yet another 100 basis points next year. If, in fact, they're so focused on getting inflation back to their 2% target, and they don't forecast that to the end of 2026, why are they cutting rates so aggressively? I think the Federal Reserve is concerned with the strength of the labor market. They're concerned with the pace of this economic slowdown, and consumers and investors are starting to pick up on that as well.
And certainly we have had some Fed speak this week that has talked about the onus that is now on the labor market, and even just some of the data we got today, a few different components across a few different readings showing some weakening in the labor market as well. One of the things that propelled the market today, though, was the stimulus actions we saw in China, which actually caused materials in the S&P to be the best performing sector. Is China investable, or do you steer clear?
We steer clear for the most part. We have a market weight to emerging markets, but we let our active managers decide where to allocate within that space. It's very hard to keep up with the volatility within emerging markets. What I will say is that with respect to the China situation, China has some deep problems. They have the decoupling that's occurring across the supply chain, which is only going to accelerate with whichever administration takes over, in all likelihood, greatly accelerate if we have another Trump administration. Then we have the lack of confidence internally from a domestic consumption standpoint, and we have a very significant youth unemployment situation. And then we have the overbuilt real estate sector and infrastructure sector. None of that is going to get fixed through one round of stimulus. This is a multi-year healing process for China from an economic standpoint. And so take your gains if you've had a nice day in China, but it's not a long-term investment thesis.
Tony, we just heard Powell talking about how the Fed is shifting the balance of its focus from inflation toward jobs. So where would you look in the macro data if you're concerned about the stability of the jobs picture to see if that's staying stable or perhaps getting weaker?
Yeah, John, I mean, it's a great question, and I agree with Kevin. He made a great point, and you made the point as well about the confidence report today, and I think that it's absolutely going to get the attention of the Fed. This is a Fed that's been very focused on consumer confidence, particularly around inflation expectations, and today's report was very focused on not just inflation, which is not a year-over-year phenomenon for consumers. It's a multi-year phenomenon. You go in and you buy, in my case, a cheeseburger, and it's $25 instead of $15. Even though maybe last year it was 23, it hurts.
Yes.
And then on top of that, of course, you have the concern around the labor market that consumers are feeling. And so, John, to answer your question, I think that when you look at the labor market, there's a mix of data. But when you look at jobless claims, we're at all-time lows relative to the size of the job market. Real wages are high, they're positive, and they're actually increasing. So the second derivative of real wages is going up. And so there are mixed signals in the job market, which is consistent with an equalizing job market, not necessarily a meltdown in the job market. And that's what we see. We see a soft landing into a better balanced labor market, not a labor market falling off a cliff.